I mean, the other thing is that you're looking at a gold to silver ratio of around about, it's just under 80. That is very, very high, particularly if you take the view that we are coming to the end of a fiat currency system. Because the other side of the end of a fiat currency system is the repatriation of gold into its rightful position, which in everyone's common law is final settlement without counterparty risk. It is the true money. And silver has a subsidiary role in that. So we're likely to see the gold-silver ratio fall very substantially. What does that mean? It means the silver price goes up to 100 quite easily. I mean, don't hold me to a particular figure, but, for example. And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat.
Veteran analyst Alasdiar Macleod claims that a significant development in the gold and silver markets is currently underway, and that it portends the collapse of the paper money system. He claims that the paper-based trading system that has regulated metal prices for many years is beginning to show signs of weakness. Important forewarning indicators are already appearing, including worsening futures, market backwardation, rising prices accompanied by declining open interest, and mounting pressure on bullion banks to cover large short holdings. These are indicators of a stressed system, not a fresh speculative purchasing. Macleod cautions that the current state of the London and COMEX markets shows a widening gap between paper contracts and actual metal. While demand for physical delivery continues to rise, the supply of genuine gold and silver is rapidly becoming scarcer. This issue is significantly more serious in silver's case. The market has been forced to rely on diminishing inventories in order to survive years of persistent supply shortages as industrial and investment demand greatly outstrips mine production. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
What are the telling signs that don't lie?
Well, I think what you've got to look at is the relationship between speculation and changes in the price. I mean, COMEX is an openly visible market on this one. When you see the price rising and open interest either not following or even contracting, that is a clear sign that the bears are being badly squeezed. And if you look at the level of open interest in gold, it's around about 480,000 contracts, something like that. That's not overbought at all. Yet we've been, as you said earlier, we've been hitting new highs day after day after day. So where's the overbought? It's not overbought. Okay, you look at the RSI indicator. Chartists will say, "Oh, that's overbought," and all the rest of it. But they're looking at the wrong thing. Man does not survive by charting alone. You've actually got to look at the market. So this is a very, very difficult situation for market makers in particular, in futures markets and also in the forward markets in London. I mean, I think in the broader context, what we are seeing is, if you like, the relationship between paper and physical becoming very, very strained. And I think it's a symptom of the end of the fiat currency system. We are beginning to see that the fiat currency system is in huge, great difficulties. Of that, there is no doubt. And fiat currencies don't last forever. They've always got a limited span, and they always collapse, and they always collapse in the same way. They collapse basically because there's just too much debt. The debt just mounts up and mounts up. I mean, the whole point of a fiat currency is you can issue the thing, without constraint. So obviously it gets issued without constraint. So that means there does come a point where the fiat currency can be no more. We've seen, every collapse of a fiat currency is really from that sort of, from the overloaded debt, the accumulation of debt. And if you like, the dependence of governments on issuing yet more and more currency. Basically, the shortage of silver has built up over a long period of time. I mean, if you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years, and it's in supply deficit this year. And the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stocks. So, we've come to an end of that. And, the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. I mean, basically that accounts for most of it. So the liquidity is actually very, very low, what's actually available. So what we see is authorized participants, as they're known as, the big banks, if you like, who will be listed on SLVs, for example, prospectus. What they can do is they can sell SLV stock for physical. So what they're doing is they're going out and they're borrowing silver, SLV stock from pension funds, insurance companies, whatever, wherever they can get hold of it, and paying a huge, great premium to do it. And actually, it's that there isn't any supply of SLV stock anymore, but they then sell it into the market for bullion and then deliver it, and they're left with a short position. They've got to cover that at some stage in the future. So, this doesn't actually resolve the problem. It just deals with one bank's particular position, short term. It's rather like payday loans. You run out of money and you've got the bills to pay, and you're not going to get paid until next Thursday or whatever. So what do? You go out to payday lender and you pay 120% or whatever the figure is to finance your position for 3 days. That's all they're doing. So this is just storing up continual trouble in the market. I just don't see how this one can really be resolved, because the problem is that all this is going into secure hands. I mean, people are hoarding the stuff effectively. And now, because this is so public, people are subscribing for, guess what? ETFs, silver ETFs, which is reducing. I mean, the silver, the managers of silver ETFs they've got a problem, because they've got to now try and find some silver. And there's very little available in the market. So all these talks about flying silver from New York back to London, I should think most of that silver is spoken for by the ETFs. I mean, when's it going to end, Alex? I just cannot see. This squeeze, I think, has got a long way to go, I must say. I mean, the other thing is that you're looking at a gold to silver ratio of around about, it's just under 80. That is very, very high, particularly if you take the view that we are coming to the end of a fiat currency system. Because the other side of the end of a fiat currency system is the repatriation of gold into its rightful position, which in everyone's common law is final settlement without counterparty risk. It is the true money. And silver has a subsidiary role in that. So we're likely to see the gold-silver ratio fall very substantially. What does that mean? It means the silver price goes up to 100 quite easily. I mean, don't hold me to a particular figure, but, for example. And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we've got to get back in. But
recent changes in the precious metals market point to a serious and expanding issue with the global gold system that is getting harder to hide. The Bank of England's gold leasing activities have suddenly preserved liquidity between London and New York for decades, ensuring the system's seamless operation. However, that system is now malfunctioning. Large amounts of gold, mostly leased gold that would never be returned, were removed from the bank's vaults earlier this year. This implies that central banks are reducing their involvement in the leasing market, which has long been the unnoticed backbone of the bullion market. The system loses one of its main sources of invisible supply if this consistent flow of leased metal stops. Alasdiar Macleod asserts that the stress is no longer exclusive to gold. Now it's moving to silver, where it's hard to conceal physical shortages. In the past, bullion banks could covertly close these gaps, but the current geopolitical tension, global debt, and transparency have made that untenable. What we're seeing is a true short squeeze motivated by actual scarcity, not speculative trade. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
A timely question, let's put it that way, because what we're seeing in the markets at the moment is a squeeze on lack of liquidity. It's very obvious in silver. It's less obvious in gold because you're not getting the high lease rates and backwardations between London and New York. But nonetheless, there is a squeeze in gold because following earlier this year, when masses of gold were taken out of the Bank of England vaults, basically, to arbitrage into New York, that a lot of that was leased gold because the principal storers of gold in the Bank of England are other central banks, and the Bank of England has always encouraged other central banks to lease their gold as part of providing liquidity in the London gold market. Now, when you see it actually disappearing out from under the Bank of England's control, you wonder if you're going to get it back. So I really do think that central banks as a whole are withdrawing from the gold leasing market. Now, this is very important because it's been leased gold, which has been hypothecated, rehypothecated, rehypothecated to keep the whole system, sort of swimming along. And without that leased gold, we're going to end up with a bit of a crisis. And the other thing which I was sort of thinking this morning, Alex, is that we've had problems in the past in the bullion markets, but they've never been publicly aired, if you like. Only sort of well after the event, you hear that so-and-so had to be rescued or whatever. There was I can't remember that there was a bullion bank way back in Eddie George's days, and I'm going back to, I think, sort of very early 2000s, when he had to sort of disappear off from a meeting or from smoking a cigarette outside the Bank of England, because he was a wonderful trader and a really, really good guy. He had to go and help rescue this problem. This just doesn't happen now. I mean, we just don't see it. But suddenly, yes, we do see it. And it's all over the press. Everybody knows about, that there's a shortage in the physical and the silver market. I mean, they come up with different conclusions as to how to resolve it and what is likely to happen and all the rest of it. But this is a new thing that's become very public, and it must make it very difficult for the authorities to manage a crisis, if you like. I can't see really how this crisis can be easily managed. I mean, in the past, there wasn't, if you like, the sort of current overall level of indebtedness. You had speculators, if you like, driving prices. But if you look at the open interest on COMEX, the speculators are not there. I mean, this is all short squeeze. And how do you remedy a short squeeze? Well, you supply some physical into the market. But who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone onto the critical minerals list, or at least it's been recommended, so it's unlikely that the US government will come to the rescue of London on this one.
According to Alasdiar Macleod, the current state of the markets is characterized by a pronounced liquidity crunch and a scarcity of gold and silver to satisfy demand. He claims that although gold is also under pressure, it is less evident silver is the metal where it is most noticeable. Large quantities of gold were removed from the vaults of the Bank of England earlier this year and transported to New York for exchange. The issue is that a large portion of this was gold that was leased and owned by foreign central banks. Once it is out of the Bank of England's custody, there is no assurance that it will ever return. Because leased gold has long been the unseen backbone that kept the entire bullion market liquid, Macleod says this indicates that central banks are discreetly withdrawing from the gold leasing market. He underlines that the same gold could be rehypothecated, lent and relent repeatedly due to this leasing mechanism which created an artificial supply and maintained price stability. That artificial cushion is eroding now that central banks seem to be retreating, and the system may soon experience a true crisis of confidence. When comparable situations occurred in the past, authorities handled them covertly behind the scenes, so the public was unaware of them until long after the fact. Macleod notes that although there was no speculative buildup this time, Speculators may have been the blame for significant price fluctuations in earlier decades. There simply isn't enough physical silver available, and those that sold paper contracts are rushing to acquire real metal to deliver, which is what's causing the price spike. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.